So Mr. Trowbridge is a CCIM. He is the founder of the Trowbridge Law Group. He is a senior CCIM instructor emeritus, which just means he will always be a CCIM instructor. He can't be fired. He got that emeritus status, even though he does not teach the core courses anymore. He just finished yesterday his syndication and crowdfunding workshop, which he does a few times a year. He's represented over 500 clients. He's a former syndicator and now a syndication attorney. Specializes in 506B and 506C offerings and has represented individual offerings in excess of $5 billion. And he is the author of It's a Whole New Business, which is this book, which you guys always see me recommend on a consistent basis. And if I had to guess, Mr. Trowbridge might have a little special treat for you guys. So without further ado, I am going to stop sharing my screen and I am going to give this over to Mr. Gene Trowbridge. Well, that didn't work.
All right, so I just need to do the mechanics here, and I think we're set. Let's see, does this go? How about that? David, I think we're on. Can you see the screen?
Yes, sir. You are on.
Can you hear me?
Yes, sir. We can hear you.
Good. Well, good morning to everyone. It's a great pleasure to be with David and his minions at Multifamily Intensive this morning on Saturday morning. I'm actually sitting in Phoenix, Arizona. I'm headquartered in Southern California, in Orange County, but I'm in Arizona this morning at a workshop myself. Took some time out to be with you. What I'm going to talk to you about today is federal law. So even though I'm in California, Arizona, and you guys are in Alabama or wherever, it's all the same law. It's federal law. And the reason it's federal law simply is you're going to go out and find an investor that's in Georgia, find a property that's in Alabama, and you're sitting in Louisiana. Something goes wrong. Where do they go to court? They have to go to federal court. That's the only place they can go because there's no one state that has jurisdiction over all the people. So that's why it's federal law. So there's my email address if you ever want to get a hold of me, Gene at Trowbridge Law Group. And I know David just introduced me, but here's a picture of my good-looking firm, and the firm has done quite well. We're up over $6 billion now in equity raised. Last year itself, we did over $1 billion in raising, which is pretty strong for a group my size. That's pretty darn good. I'm proud of it. I wanted to tell you a little bit this morning about the scope of the private placement offerings. What we're talking about is not going to the SEC, getting full approval, and putting your offering on the New York Stock Exchange. That's what's called a registered offering. What we're talking about is private placements. And private placements simply are, we don't have to go to the SEC and go through the 6, 8, 10-month process and the $200,000 to $500,000 it takes to get our offering registered. We can do it much more simply, which I hope I'm going to be able to point out to you today. However, as you can see from this slide, I'm sure the numbers are big and you say that's kind of big. The private placement market in the last 12 months, according to the SEC, raised over $2.1 trillion. And that's up from 1.8 trillion the previous year. So that's a lot of money. That actually is more money than the new money that came into Wall Street during the same 12-month period of time. Now, even though that's a lot of money, more than 2/3 of the offerings had less than 10 investors, with the average being 14. Well, that's pretty interesting. And that kind of represents what happens at my firm, although I would say our average is probably about 20 to 25 investors. I really haven't studied that, but I think it's a little bigger than that. Here's what's important, and you don't really know what 506B means yet, but $1.9 trillion in the last 12 months was raised in 506B. So I think we're going to want to know about that. And the median size of the offerings throughout the country in 506B was $1.8 million. In our firm, the median size, is 3.5 million. So we're a little bit bigger. 124 billion during the last 12 months was raised in something called 506C, which we'll talk about, and about 900,000 for the median. But that's interesting in that doubled the amount raised in the previous year, and I'll talk about that when I talk about what 506C actually is. And here's what you really need to know. It says 99% of all the exempt capital, that's the 2.1 trillion, 99% of all that capital is raised under Regulation D, Rule 506. So I guess if we're going to talk about raising money from multiple people to go out and buy a property, and we want to do it the easiest way, we're going to do a private placement, and we're going to be in good company because a lot of people are doing it. Now, you need to know that that's not all real estate. In fact, the statistics are that it was $45 billion raised in Reg D offerings, in real estate offerings last year. So it's really a small portion of the total, but that's still $45 billion being raised in private placements going into real estate. And some of you might wonder, well, how did COVID affect money raising in the last 12 months? The previous 12 months was $38 billion into real estate, and this 12 months was $45 billion. So we're raising a lot of money even in the COVID period. And one of the things I want to just say here is that I've provided David with a PDF of my slides. So he's going to distribute that to you later. So that'll be helpful. You can go back and look at this information. If you're a real estate broker and you go out to take a listing on a property, or you want to sell a property to someone, and you go to look at the title, it's very common, actually it's more common than anything, that the property is owned in an entity, not Gene and K Trowbridge. It would be owned in an entity. And that's what this picture is. This is how you'll find a lot of properties out there in the marketplace. The property is owned in an LLC that I'm going to call Investment LLC. That's what the title is. That's who the borrower is. And when the lender goes to qualify, they look at the property and they look at the investors behind the property.
Hey, Gene.
So, yes.
Do they, with commercial properties, do you put them in trusts commonly the same way they do with single family, or is that just a single family thing?
That's a single family thing.
Okay.
LLC is what's going to do, because as I'm saying this, what you're going to find is there's going to be multiple investors. And so that won't work for a trust. Now, you may very well have one of the members who's investing in Investment LLC invest through their trust. You see the difference there? The trust might be at the individual member level, but not at the not at the title holding level. So in this example, we have the members, one or two members go out and invest in the LLC and they buy the property. Maybe they got an SBA loan, they're going to run their business out of it. So that's pretty common. In this picture, what I have is I have a member managed LLC. The members make all the decisions. There's no one making a decision over anyone's money. There's no one who's passive. They're all active. And actually, to do this correctly, if there's voting going on, everyone has an equal vote, regardless of how much money they invest. I could put in 10% and David could put in 90%. But when it comes to vote, if we're going to keep this a member managed LLC, we would have two equal votes. So no one is in charge of my money. Well, as you can tell, that might cause a problem if you've got 10, 15, 50 investors. You can't really do it. So we need to probably have a little different picture. I got to stop. There was something I wanted to say at the very beginning that I forgot. A lot of people come to me and say, Gene, I want to put together a syndication. 4 or 5 people want to buy a property. Or I want to put together a group of 4 or 5 people together to buy a property, but I don't want it to be a syndication. Wrong question. A syndication is 2 or more people combining their money and their management expertise to do some business venture. When you go to the movies, in the movie theater, there's all these logos up front of all the different companies that have combined their money and their expertise to make the movie. That's a syndication. So this would be a syndication. A very small group of people coming together in a member-managed LLC to be a syndication. The better question to ask me is, Gene, I want to put together a group of people, but I don't want it to be a security. That's the issue, because that's the whole new business that you need to be aware of. When you put together investors in a group and someone is in charge of that group, you're going to see that that's a security. And so the title of my book is It's a Whole New Business, because when I wrote the first edition way back when, it was written for real estate people so that they would understand, as opposed to brokering properties to one person, they're brokering a property to a group of people, and they're now in the securities world as well as in the real estate world. So it changes the business model. And here's how it looks. Now we've got investment LLC, which is owned, which is formed to own a property, okay? We have members who are going to purchase interest in the investment LLC. But there's too many members. There's too many members to have even votes and equal votes. So we need someone to be in charge. And that someone is called the manager. Now, you'll see this language, and I'm just going to point out that this is a very vocabulary intense industry. On this picture, you don't see the words limited partner or general partner, because there's no such thing as a limited partner or a general partner in the LLC world. If my picture had shown investment limited partnership, then the people are called limited partners and general partner. And there's a whole set of different rules for those people. But in an LLC, they are members and they're the manager. They all have limited liability. They're only liable for the money they invest. And they all can participate in the decision-making process if you want them to. That's totally different from a limited partnership where the investors, the limited partners, can't vote at all. And the general partner is totally liable. So this is the preferred way today to buy real estate. in a group investment. It is the limited liability company. So what I have here is I have the picture of the investment LLC, which owns the property. So the bank comes in and appraises the property, looks at cap rate, looks at debt service coverage ratio, and decides how much of a loan they can make. But then they always also have to underwrite the borrowers. Well, they're not going to underwrite all the members. They're going to underwrite the manager. So the people who are in the manager LLC can expect it to be underwritten by the lender and can be expected to sign the loan. David, does my arrow show up here? I've got an arrow in manager LLC. Does it show?
Yeah, it's a little black arrow. It's showing.
Okay, good. So in the manager LLC, that's where you make your money for doing all the work. The members invest their money in investment LLC. It stays there until there are distributions and it comes back to them. Hopefully, the manager is going to invest some money and they're going to get some money back in distributions and fees. Now, there's one other box on here. When you go to the lender to get qualified for the loan, it's possible that the members of the manager don't have enough net worth. Generally, the lender will look for net worth equal to the loan amount. So if you're borrowing $3 million in this manager LLC, we have to have people who collectively have net worth of $3 million. And maybe you don't have that. So then we go down to the enhancer box, and the enhancer box, excuse me, and I call them enhancers. You can call them sponsors, angels, key principals, whatever. That's generally something that happens when the lender gets involved. We need more credit worthiness. We need more liquidity. Boy, you're in Alabama and you're managing a property in Texas. You don't have management capabilities. We better go out and find a local property manager. So all those things might come up through the lender's requirements. But generally what we have is, I'm going to use this, I'm going to explain something with a certain set of words here. We have investors who invest money in a common enterprise with the expectation of profit through the results of someone else. So this isn't like GoFundMe. This isn't charity. This is you're putting your money in to the LLC. The LLC owns a property and ideally you're going to show a profit, but none of the members are really going to deal with the day-to-day management. It's the manager who's found the property, is out trying to get the loan, is negotiating the contract, is going to manage the property. So it's through the efforts of someone. So we have a bunch of passive investors, and then we have the active investor. Well, this is totally different than the previous picture. Why is it different? Because of this manager box. And this is what makes it a security. The government has, way back from the 1933, the government has always shown an interest in protecting these investors when there's someone else managing their money. So that's when they wrote the two securities laws that we work with. And it's still the same today. It's the same definition. It's the same thing. So when people call me and say, hey, I want to put 6 or 7 people together and I don't want it to be a syndication, well, it is a syndication. And if I change the question, you don't want it to be a security. Well, how do you make it not a security? You have to get rid of this box. You have to go back here and everyone is making equal votes on major decisions, and that's overwhelming. That's very difficult when you have a lot of investors. You know, some of the master LLCs that are out there have hundreds of thousands of investors. So you're going to have someone who manages it. So that's a pretty important picture. When you get the slides, you want to look at that. That's the picture of the definition of security. Well, why the hell would you do this? You would do this as a manager so you can make some money. It's a business, okay? It's not a charity. You're finding opportunities, and then you're sharing those opportunities with other people. There are a lot of other people out there who would love to invest in investment real estate, multifamily, storage, whatever, but they don't have the money to buy the property themselves. They don't have the expertise to run it themselves, right? And they just like to be passive investors. So you're going to find an opportunity, and you're going to share that opportunity with the people. And because you're doing the work, you're going to get paid. I've just listed some of the ways that you can get paid. You can take ownership interests. You can get acquisition fees, asset management fees. You might get a fee on the disposition. You probably are going to share in the operational cash flows, the refinancing cash flows, the sales proceeds, all sorts of things you can generate income for yourself. But down at the bottom, and I have it blacked out, it says possible real estate fees for licensees. My advice is you don't take on the business of being a manager in an LLC just to get a listing commission, just to get a sales commission. It's too much risk. You can sell the property to someone else and collect your commission without taking the risk of being a manager. And when you read my book, if you go ahead and we're going to provide a free copy of my book when this is over to you, you'll get more discussion of that and all these things I'm talking about. So because the government had a vested interest in protecting investors, it made two securities laws back in 1933 and 34. The first law is designed to protect the public against fraudulent investments. And the basics of that law, which is thousands of pages long, is provide full disclosure. If anything goes wrong in your offerings and someone comes to cut some legal remedy against you, the major question will be, did you tell the investors all the material facts that you should have been aware of at the time of their investment? Material facts ahead of time so the investor can make an informed decision. That's your responsibility. And that's why attorneys like me draft the documents, because that's our responsibility, is to work with you and make sure the documents do provide full disclosure. So you're going to have to worry about that law. The other law is designed to protect the public from those who sell fraudulent investments, fraud and misrepresentation. And that law, we don't really have to worry about too much, because that law generally requires someone who's going to sell a security to be licensed to sell a security. However, they made a big carve out of that law. And the carve out is just like in real estate, where we have for sale by owner, except their language is the issuer. So if you're the managing member and you're issuing interest in investment LLC, your own interest, you do not need a license, but don't sell anyone else's interest. In that case, you would need a license. So we're primarily interested here in providing full disclosure through our documents. So there's a court case, and if you ever want to read anything and read my book, the section on securities, chapter 5, I go to length about the Howey test. Well, all the Howey test said, which was really a real estate case, people bought lots in an agricultural farm, and when they bought the lots, the people who ran the agricultural farm says, we'll take care of everything. we'll raise the fruit, we'll harvest the fruit, we'll package the fruit, we'll share profits with you. We'll do everything. So all these landowners came in and they were buying under land contracts. They have nothing to do. And what did they buy for? They bought for the share of the revenue. And this was in Florida, maybe to come down to Florida once or twice a year to look at their acre of orange trees. I don't know. And unfortunately, the agricultural company went bankrupt and they tried to foreclose on all the land contracts. And some attorneys took them to court and said, you know, no one bought this acre of land for the orange trees. They bought the acre of land because Howie promised to take care of it, raise the product, harvest the product, sell the product, and share the revenue. In fact, the people couldn't do that. And so at that time, this was in the early 40s, no one had a definition of investment contract. An investment contract is in the securities law, but no one knew what it meant. So the Supreme Court finally got this case and said, this is the perfect case to explain this. It's an investment of money in a common enterprise with an expectation of profit solely from the efforts of the promoter. And where we all get into the securities world is right here. The fourth prong, solely from the efforts of the promoter. A member managed LLC, everyone invests their money in a common enterprise. They expect to make a profit, but they're doing all the work themselves. In a manager managed LLC, it's the efforts of the promoter that get you into the securities world. So here's my flow chart. My mind is a flow chart. So the question is it a security? Well, on the left-hand side, the answer is no. It's a member-managed LLC, so forget about the security world. But yes, if it's a manager-managed LLC, it is. You're in the securities world. Now, where do you want to go from there? Every security has to be registered with the SEC unless it's exempt. Okay, so you're over here in this black box where it says public offerings, small public offerings, and Reg A. Some of you will be aware of this. Our firm did the first Reg A plus offering for Grant Cardone. And we had to take that offering into the SEC. It's a little less than a full registration, but it took 6 months and it cost a lot of money and there was a lot of review on it. So it kind of was complicated. But over here in the orange, where it says offerings are exempt from SEC registration, that's where the $2.1 trillion is raised. Offerings exempt from SEC registration, private placements. And there are two ways you can have a private placement. You could do an offering that's totally in Alabama. The managing member is in Alabama, the property's in Alabama, and all the investors are in Alabama. In that case, you have to go to Alabama and look at their own rule. And that's called a intrastate 147 offering. And if you do one of those and you do it right, you're exempt from SEC regulation. We don't find that's extremely helpful because you'll put it all together to be an Alabama only offering. And someone will say, hey, Uncle Bob up in Georgia can put $2 million in this deal. You don't want to turn Uncle Bob down, but if you take Uncle Bob, you have to start all over again. So our business is Regulation D. Regulation D was the exemption that they wrote back in the original law and was modified quite heavily in 1981. That's where, I think my first slide said 99% of the private placement money is in 506B or 506C, which is in Regulation D. I need to give you one definition before we go in and talk about B and C. Initially, the securities laws were written so that rich and smart people, and that was their words, did not need protection. So if you did an offering and all of your clients are rich and smart, you could be exempt and you didn't need protection of the securities laws and the SEC. Well, how do you know who's rich and smart? Wouldn't you guys please be a little more definitive on your definition? So, and this came about when I was syndicating back in 1981. They passed changes to Regulation D, and one of the changes they made was to define rich and smart, and they used the term accredited. So back in 1981, they said anyone who has a net worth of over $1 million is going to be rich. Anyone who has $200,000 of annual income if they file individually, or $300,000 if they're married and filed jointly, are rich. And that's always been the same, and that's still the same today. After 2008, Dodd-Frank came along and said, you know, a lot of people have $1 million of equity if we count their equity in their primary residence. And we don't think that's right. That doesn't mean they're smart enough to be an investor. It just means they bought a house in 1956. It's now 82 and it's worth $1 million. They're on Social Security by now. So they excluded the primary residence from the calculation of $1 million. And that took about 1/3 of the accredited investors out of in the country, out of the accredited investor definition. Well, that's been the same. Those dollars amounts have been the same. And you think about it, in 1981, $1 million, as they say, was worth something. Oh, maybe not so much now. And there has been challenges from people who would like them to increase these numbers, if nothing else, just for inflation, but they never have. And then they dealt with the issue of, well, what if it's an entity that's going to invest? What if it's a trust, an LLC, a family office? What if they want to invest and there's a lot of people in there? How do we know? And they said, well, if it has $5 million in assets, we're just going to call it accredited and we won't worry about the individuals. So that was the rule until last year. And last year, in order to promote capital raising, the investors or the SEC gave some expansion to this. The first thing they said is there are 3 types of licenses out there that securities people have where they would be selling private placements. And after we go through all the checking and all the background checks and all the testing and grant these people a license, we're going to call them accredited regardless of their income or net worth. Fine. And then they expanded this entity definition to be family offices, IRA, 401k, like my law firm. If my law firm's 401k had $5 million in it, it would be accredited, regardless of the 6 or 7 people that are in my firm and what their individual status is. Another thing they added, and I guess I skipped it, was spousal equivalency. The world has changed, and there are households now where people live together as a household, but they're not married. So now spousal equivalence will allow you to meet the net worth or income test. And then if you work for the sponsor and you're out there helping them do the deal and raising money, you're accredited in that deal only. So that's an expansion of the definition of accredited investors that came around last year. So here's a picture, and we could spend an hour on this, we won't. Regulation D, when they defined accredited investors in 1981, gave us the box that's on the left-hand side of your screen. At that time, it was just simply called Rule 506. And they said you could raise all the money you want. You can have an unlimited number of accredited investors. because you know them, they can just check a box and self-certify that they're accredited. And big change, you can take 35 people who are sophisticated but not accredited. Sophisticated. Are they smart enough to read the book, understand the asset, and understand the risk? That would be sophisticated. You have to do a private placement memorandum and no advertising or solicitation. This is what commonly is called the friends and family. Well, it's not the friends and family. It's anyone you have a relationship with. Okay, and I've got a couple words on that a little later. So that was 506, and that was around until 2012. And in 2012, the Jobs Act came along and Congress said, we need to promote capital formation even greater. So what we're going to do is we're going to come up with a new rule, 506C. And in this rule, we can raise as much money as you want from as many accrediteds, but because you don't know the accredited investor, you don't know your investors, you're advertising, we're going to need a third party verification to be reasonably assured that every investor is accredited. You can't stop who you advertise to, but you can make sure your investors are accredited. No sophisticated investors can come to you through advertising. You need a PPM, and advertising and solicitation is allowed.
Hey,
well,
Gene,
yes.
quick question. Can you have a 506B and a 506C invest in the same end property or an investment? So I could run a 506B, have my friends and family, but at the same time have a 506C running and advertise and bring in all these other investors and then marry them up together down the line. Is that legal?
Gene, before you answer that, guys, please wait and hold your questions to the end. Gene is limited on his time. We'll let Gene answer this because this is an important one. But
it is an important one, and
it's
a new wrinkle. It's a new wrinkle. I'm just going to explain how you would do it. You come out with an offering. The offering says, we're going to raise money under 506B until we stop. And if we stop before we're fully funded, we will continue strictly with 506C. Same offering, same paperwork. So what we do in our company, you do the 506B, and when you stop, you've raised all the money from friends and family, and that's important because all those accredited investors can just check the box. That's wonderful. You stop. We file something called a Form D, which tells the government that 506B offering is over. Now, with the same documents, the same subscription agreement, the same everything, following the rules, we can continue our offering under 506C. From that point forward, everyone has to be third-party accredited, okay? Because now you're under 506C and the offering is closed, and then we file a Reg D on the 506C part of the offering. We have to be specific and unambiguous to the SEC when the 506B offering ends, and we do that with the Reg D. So yes, the answer to your question is, in the last 18 months, we've had clarification that we can do something like that. Not exactly in the way the question was asked, but in the way I answered it. So we've got two deals, 506B, 506C. What did we say early on? 1.9 trillion is raised in 506B during the last 12 months, and 124, that was 1.9 trillion in 506B and 124 billion in 506C. And what's important is there's a big gap between those two. But 506C volume last year doubled. So even though it's been out since 2012, it's taking a while to gain traction. And I would say, David, that all your people are going to start their first deal in 506B. They're going to do a small deal with the people that they know, and do it easily, and don't advertise, and don't worry about third-party verification. So 3 words that you need to learn: sophisticated, pre-existing, and substantive. On my YouTube channel, Trowbridge Law, I have a YouTube called 3 Words, and I go through all that. Sophisticated is what type of an investor who isn't accredited can invest in your 506B. And then if you can't advertise, how do you protect yourself from a charge of advertising? You only take investors into your 506B with whom you have a pre-existing relationship, a relationship prior to when you hire an attorney to do your documents. And you have to have a substantive relationship, not just a name in your database. You actually have to know, are these people sophisticated? Are they accredited? What's their investment experience? You have to have a relationship with them. If you're just going to dump names in your database and just market to all those people that you don't even know, you haven't fulfilled the 2-pronged test to defend against a charge of advertising, pre-existing and substantive. So if you want more about that, you could go to my YouTube channel. Now, I write documents. That's what securities attorneys do. And one of the documents is the story. It's called the Private Placement Memorandum. And you can see all the circles on there. Those are all sections of the document that I have to write. I work with you. I do what's called a deal structure interview, and I work with you. Every attorney does something like that, and get all the information. We write the story. We tell you about the story. You review that, and if we have the story right, then I have to write the rules. And the rules are an operating agreement. Texas is called a company agreement, but generally it's called an operating agreement, and it is the rules of how this thing works. So this is what the investor looks to. The PPM is just a story. It's not a contract. It's just a description of what's it all about. It's about, did you give the people all the material facts before they invested? This is the operating agreement that the managing member signs and promises to operate the project in this way, and you can hold their feet to the fire if they don't. And then when you're ready to invest, there's a 3rd document that's called the subscription agreement. You'll get that document and you'll go through and you'll say, yes, whatever I'm going to tell you on the offering questionnaire is true. I read the PPM and the operating agreement. I understand it. I've had a chance to ask questions. I meet the suitability standards that you set, sophisticated or accredited. You would tell me if I was a sponsor how much you'd like to invest and how you're going to hold title. And then you'll have an offeree questionnaire. It's the sponsors. It's in the sponsor's best interest to get to know something about the investors, even if it's an advertising investment where you don't know the people. You still kind of need to know how old they are and where they live and all that stuff. So the offering questionnaire is part of it. What do syndicators say after they've done this for a while? First of all, the care and maintenance of partners is overwhelming. The risk is greater than you expect. I syndicated for 20 years. And as David knows, in 1995, I said, that's enough of this. Those partners will wear me out. I was representing about 850 partners at the time in 16 offerings. And each offering in mine had 2 properties because we were building storage facilities. I said, I quit. I'm not going to do that. I'm going to law school, go to the dark side. So I went to law school so I could still work in this industry. It's the only type of lawyer I ever wanted to be, but that's a challenge. And the risk is greater than you expect. And I'm just going to make one comment on this. You know, real estate is risky. Fine. But did you know that having 20 or 25 investors in a deal whose lives change over the 5 or 6 or 7 years you're holding the deal? Did you know that brings you risk? Yes, it sure as heck does. And big mistakes. You got to have enough time to raise your money. I think you need 60 to 90 days from the time you hire an attorney until the escrow closes. You can't take any money until you have the documents and you have the investment LLC bank account open. That's not your money. You put it in your bank account, you're commingled. You have to wait till the bank account is open. Because of the law on securities and raising money, the issuer exemption, you can't pay finders to help you raise money because the finders are not selling their securities, they're selling yours. So they better have a securities license. The biggest mistake would be drafting your own documents, not reading your documents after you pay money to an attorney to draft documents. Let's sit down and read them. Because I'll tell you what's going to happen. You're going to hand your document to an engineer and they're going to read it. And then they're going to ask you a question about something on page 47, and you better know what it is or you've lost your credibility. Don't make cash distributions from reserves. Cash distributions only come from operations. You might have a whole bunch of money sitting in the bank to redo all the air conditioners, but that's capital. That's the investor's money. You can't make a distribution and tell the investors, oh, this is what we made this quarter, if you're just giving them their own money back. As my wife says, why would anyone invest with someone whose name was Madoff? Okay, that's how Mr. Madoff ended up in jail. Okay, and cashing out investors with money from new investors, that's another thing he did. At the end of the cycle, the investment hadn't really done what it was supposed to, so he raised money from a new investor, took the money and paid off the old investor. Fraud, fraud, fraud. Okay. So, as I said, David has made arrangements with me to give you an opportunity to get a free PDF of the 4th edition of my book. So if you have your phone with you now, you can scan this, but you might not have it. But when David sends you the PDF, this slide is in the PDF, and then you can scan that, and that will get you a free copy of the PDF. It will also give you an opportunity, if you just want to pay the postage, that I'll send you a hard copy of the book. And it also will tell you that on Amazon, there's an Audible version of my book that I just recorded in January. So I think that's a good deal. And the book is written for real estate people, so we can, you'll understand it very, very well. Contact us. That's my contact information. David, I don't even know, what time is it, David?
It's 12 minutes to the top of the hour.
Good. So I can take some time to answer some questions as long as I'm gone at the top of the hour.
Before you guys get into questions, can you briefly cover, Gene, if they put together either member managed LLC or a manager managed LLC, how they can joint venture with other LLCs similar to theirs,
Sure,
to be able to bring in larger deals without the need of the SEC for that property LLC.
Well, no, I can't. But I will tell you that when you raise your money for your LLC, that's an offering.
Correct.
And if you tell the people what I'm going to do is I'm going to be a joint venture in offering with Gene, okay? Because Gene owns the bulldozers, but he doesn't have any cash. Okay, so we come together and we can do that offering. That part of it's not an SEC issue, but when you raise the money from your investors, correct, and you're handling it, that would be an offering, and that's where you get paid from. You get paid from your offering. Even farther than that, David, as you know, we have companies who put together LLCs exactly for that purpose. Exactly for that purpose. That my most prolific client has done 154 offerings with me since 2014, and that's what they do. They have identified, I would say, 10 to 15 developers around the country, multifamily, many hotels, student housing. And these developers go find a project, and the developers don't have the cash, so they go to my client, who brings $6 to $10 million into a joint venture, basically, with that person, and that money's there until the project is done. The permanent financing comes on, and my client gets paid off. When we raise the money in my client's offering, that's the security.
Right. Perfect. So we've got 3 questions, and then I'll get to hands if we have time beyond that. So the first one is Manager LLC always comprised of a subset of the members of Investment LLC?
It probably never has, well, I shouldn't say never, but more than likely Manager LLC is the person who's doing the deal. Now, one of the questions an investor should ask is, Gene, if I invest in this offering, what happens if something happens to you? Well, I better have multiple people in Manager LLC. And are they also members? Maybe, maybe not. But that's important. You have to have continuity. You know, in the last couple of years, what have we had? We've had people die of COVID. We've had people just die. We've had people go bankrupt. There are all sorts of reasons that if I were to advise your listeners, I would tell them never invest if the manager entity is just one person. Never.
I give the same advice.
Good.
The second question is, I've heard a Series 65 is typically required for fund managers to collect management fees. How are asset management fees different?
Well, first of all, a fund manager has a definition, and nothing we're doing here is a fund manager. You're not telling people to invest in other people's offerings and managing their funds. You know, that's not it. You do not need any securities license to sell your own offerings. And asset management, strictly that term, is managing the company. We've got ABC Equity Group, and to manage that company, we have to meet with attorneys and accountants and send letters. You need to get paid for that. That's different than property management. But yes, a fund manager, by the definition of a fund, is regulated with a certain offering, but that isn't what we're doing here.
Okay, great. I want to get this one because this one needs to be answered, Gene. Do syndicators have to disclose? Oh, I love that word, disclose, and I already know the answer to this.
The answer is yes.
It's always yes, but he wants to know, do you have to disclose who all is in Manager LLC?
I would think that would be important. Isn't that a material fact that the investor would want to know? And why would you not want to? That's going to do nothing but help you market, unless you're putting criminals in there. But if you're putting criminals in there, we're going to get you, because there's something called a bad actor questionnaire that everyone who goes in the Manager LLC has to sign. And then that's my responsibility to keep them out of there as the attorney in charge. So yes, you should. I can just see in the private placement memorandum, we have the members of the manager. And then in the operating agreement, for the company, we might not have all the members of the manager, and the manager operating agreement, which explains how the members of the manager are going to split things, that is not disclosed to the investor, but the investor should know who's managing their money, of course.
I like to live in the philosophy, when all else fails, disclose, disclose, disclose.
Right. All the material facts. You know, it's really funny because that's a tough standard. All the material facts so you can make an informed decision. I will tell you in 2017, 18, and 19, I didn't write anything in my documents about COVID. How did COVID change our ability to inspect properties, to go into people's apartments?
Yep.
I have that in there now, but that wasn't something that would be reasonably expected for someone to know. I'll tell you one of the risks features, David, that I'm beefing up and I'm putting now is that there are a lot of people doing bridge loans. They're buying property with, a little loan or a loan with 3 years interest only and maybe 2 one-year extensions, but at the end of 5 years, the loan is done. Well, that's risk. How do you refinance that? Hopefully your NOI went up. I think we're all going to be in a period maybe of increasing cap rates. Did your NOI go up enough so that in the new cap rates, with the increasing interest rates, you can actually refinance the property? And what if you can't?
Ooh, that's a big one.
That's a big one. Sometimes the company, and we have it right now in a case, company had to go out to all the investors and raise more money because the new loan can't be as big as the one that they're paying off. So they have to bring in more equity. Well, did we tell people about that? Okay,
I think we're going to see a lot of that in the coming months.
I think so. I mean, if you were in business in 2008, when the spigot turned off of financing and you bought a property in 2002 and the market was just going sky high and you said, I got a 7-year holding period, and all of a sudden it's 2008 and there's no financing at all. I've been through all those times, 78, 81, 86, 91. I've been in the business during all that time.
Yep. Another one here, and then we'll get to Steve. He's got his hand raised if there's time. There were some new rules that were being proposed on being able to take fees for raising capital for someone else as an exemption prior to COVID. Where does that sit?
Never passed.
Never passed. Okay.
Never passed. Those rules never passed.
Oh, sorry, Gene, you done?
Yeah, that was just a simple answer. Never passed.
I didn't think it had, but I hadn't seen anything on it.
Huge pushback from the state securities regulators and from of course, the FINRA.
Yeah.
The group that all the securities people belong to. And as it was proposed, it only applied to a simple introduction of an accredited investor into an offering. You couldn't tell them about the offering. You couldn't recommend the offering. You couldn't do anything. You could just simply introduce an accredited investor to a sponsor.
Yeah.
Did not pass.
Tim, Steve, you can unmute and ask your question. Thanks for your patience.
Actually, I didn't have a question. I just wanted to say, hi, Gene, good to see you. And
there's my buddy. There's a client. There's a client. That's what a client looks like.
That's right? A working client.
A working client, yes.
Hey, I wanted to say that they were still speaking very, very highly of you at this month's SEC meeting, and I'm disappointed that I missed you at the SEC meeting in January. Good to see you. I won't take any more time.
Was that in Houston? Stay on there for a second. Was that in Houston?
Yes, I believe you were in Houston. We didn't make it to Houston. Right. We made it to New Orleans this month.
About once a year they invite me, because they don't need me, 8 times a year. About once a year they invite me, and I really appreciate it. But the reason why I wanted Steve to stay on, I said earlier that sometimes clients put together offerings and their intention is to go and joint venture or invest in other people's offerings. That's Steve. Steve has an offering where he can invest in other people's deals, and you've raised some money and you've done that. That's good.
I want to mention one more thing. Gene didn't know I was going to be here. I'm not a shill for Gene. I'm a very, very respectful and appreciative client of Gene. Good to see you. Thank you, sir.
Thank you, Steve. Say hi to your bride.
Thank you, I will. She says hi too.
Good.
Well, Gene, we thank you very much. We are right at the top of the hour.
Great.
You've been incredible, getting a lot of great feedback. We'll get Gene's PDF out to everybody that is on this call, so you guys will have the opportunity to save that and get the QR code if you want to get his book in PDF. And it also, you can email him and ask him about doing the just pay shipping if you want his physical book. And you can go to Amazon where it is on Audible, which I would highly recommend. We've been waiting a long time for that to come on Audible, and he just got it recently.
Just did it. And talk about boring. Reading your own book, which I'm in my 4th edition. Writing the 4th edition was a little boring, proofreading it again and again. And now I'm going to sit in a room by myself for 18 hours. So I went off script a little bit. The book is as much a story as it is, the audio as much of a story as it is just reading the text. And don't forget my YouTube channel. We have constantly new YouTubes. I generally go into the studio every month and do 3 or 4 new YouTubes based on what questions have I received from clients or potential clients during the last period of time. And we've done 37 interviews of clients on there. Pretty interesting. 3 questions. How'd you get in the business? They all got in the business because they didn't have enough money to buy all the real estate they wanted themselves. Number 2, what do you see in the future? Everyone is positive about real estate. And now we don't just do real estate, but primarily our business is real estate. And what advice do you have for the rookies who listen? The advice is always find someone to do this with. Do not try to do this yourself. There you go.
Great advice. Thank you very much, sir. We really, really appreciated your time. And I put Gene's link to his YouTube video in the chat so you guys can find that.
Cool. Thank you very much.
Thank you, Gene.